Good evening, everyone. Welcome to the Renaissance Ascent Fund launch. Without further ado, I'll hand over to Mr. Pankaj Murarka, founder and CIO, to take us through what this fund is going to be about. And at the end of that, we hope to have an interactive Q&A question session. So with that, Pankaj, over to you.
Sure. Thanks, Shalini. And a very warm welcome to all of your friends. Thank you for taking your time out and joining us this evening. After a fairly long while, we're coming out with a new fund. So I'm pretty excited to share what we have with this fund in terms of our idea. Just give me a moment. Yeah, in terms of what we have to share in terms of ideas and thought process. So without wasting much of time, let me just straight away dive into it. Just give me a moment so that I can bring up my deck and we can straight away start. 1 second. Someone is, yeah. So as I said, after a gap of very long period of time, I think over 2 years that we're coming out with a new fund, Renaissance Ascent Fund. It's a close-ended fund that we are launching. I'll take you through the investment theme and idea behind the thought process behind the fund, and briefly touch upon the structure of the fund as well. And maybe before that, maybe let me straight away begin by giving some high-level view on the markets, because I'm sure everyone is interested in knowing that. So I think all of us know last year has been a year of challenge for India. Started with the 50% punitive tariff which US imposed on India, and which clearly had an impact on our external trade, especially our exports, and consequently we had a trickle-down impact of that on our currency. And by the time we could just get through that and get a trade deal in place, the world got embroiled into this whole US-Iran conflict. Consequence of which oil prices moved up very sharply, and which again became a significant macro risk for India, because all of us understand that India imports 90% of energy, higher oil prices, again impact on currency, higher rates, and all of that, right? The good thing is, after all of that, I think we are at a stage where India's macros are stabilizing. Over the last 3 months or 4 months, I think both RBI and central government have taken decisive policy actions to stabilize India's macro. Currency is now stabilized, and with the initiative which RBI is taken to mobilize FCNR deposit, it's coming at a cost, but it's getting to achieving its objective of at least stabilizing the currency. Last 1 year has been painful, where we've had 10-year adjustment of INR versus the US dollar, which is very significant. But now that that's been done, it looks like it's my view, considered view, that given all the policy initiatives which RBI is taking, probably Indian currency should stabilize at these levels. And more importantly, 10-year bond yield is also showing signs of stabilization. I still remain in the camp. I don't expect any rate hike by RBI in this financial year, because I think the inflation that we're witnessing is more supply side and a transitory inflation, which is caused because of rising oil prices, with Hormuz deal now, the second deal in place, or looks like the second deal being in place, and oil prices retracing back to closer to where they were. Probably inflation, after the pass-through effects are done, should moderate. So apparently 10-year bond yields should stabilize around the levels where they are, closer to somewhere between 6.8 to 7%, which is where they are. Markets over the last 6 months or 1 year have been pricing a lot of bad news. And which is what I think makes investing or outlook on markets pretty positive. That on one hand we have cyclical growth picking up, and on the other hand, probably a lot of bad news is already in the base or in the price. Every metrics that we look at in terms of absolute or relative for India on a standalone basis, or India relative to the world, does make markets and valuations look attractive. Having said that, I must concede that these are aggregate numbers. Looking at the broader indices, within the indices, there's a very wide dispersion between stocks and sectors. So one has to be very careful in terms of stock picking and sectoral allocation. But the aggregate level markets are looking pretty reasonable in terms of valuations, and with cyclical growth picking up, the outlook for markets is pretty positive. On a relative basis, if you look at India relative to the world, all of us know one of the big story of the last 12 or 18 months has been India's massive underperformance versus emerging markets. But even now that's peaking out because, as we know, that whole AI trade is showing early signs of reversal, where some of these AI-driven markets have corrected pretty sharply in the last 6 weeks or so. And India being labeled as a reverse AI trade, we've had significant or massive outflows from foreigners in the last 18 months, but they have also started showing early signs of stabilization. And I'm of the view that probably later part of this year or next year, probably we should see foreign flows coming back to India. Happy to discuss that in more detail. But having said that, on a valuation perspective, if you look at a more stable anchor of value in terms of price to book basis, then India versus India as compared to all the other emerging markets is at a valuation where it has been, last time it was around those valuations was either during COVID crash or during 2008 global financial crisis. India has always traded significant, premium to emerging markets, but on a price to book basis, now India trades at 1.4% versus rest of the emerging market, which makes valuation pretty attractive. And even in terms of contribution of India's market cap to GDP versus the rest of the world, the premium which India enjoyed has come down pretty significantly, and which again tells us that on a relative basis, relative to the other markets in the world, India is pretty attractively poised. And more importantly, as I said, we're seeing early signs of earnings recovery setting in. This quarter's earnings and significant part of the earnings are behind us have been fairly resilient, and which is what we were also picking up, during during March, April, in the midst of the conflict, that despite the conflict, the underlying demand is fairly resilient. So while there are transitory impact in terms of impact on margin for companies, but the demand momentum is fairly strong, and I think that is what is visible. And if you look at this 2-year forward rolling earnings chart on this left-hand side, and which has a very high, correlation to the what I call earnings ex prior and ex ante, then that is already turned around, which effectively shows that earnings momentum will catch up. More importantly, in the last 18 months, 24 months when we've had an earnings slowdown, India's nominal GDP growth has held through pretty well. Yeah. So, but earnings growth has been moderate. Effectively, the wedge between nominal growth and earnings have widened significantly. And I think as earnings growth come back, probably this wedge will narrow, which effectively means we'll get into a cycle. And my view is in the second half of this financial year, where earnings growth will exceed nominal GDP growth, where earnings growth have been undergoing nominal GDP growth for a while, but I think we'll get into a cycle where earnings growth will exceed nominal GDP growth for a period of time for this wedge to narrow down, and which effectively is a positive jaw or positive earnings momentum cycle. I think that India will get into in the second half of this year. Over a medium term to long term, friends, as you see here, Nifty has been a very steady compounder. Every 5-year cycle, if you see over the last 5, 10, 15, 20 years, Nifty returns have been very steady, around 13 to 14% across every 5-year bucket. So despite underperformance or India not doing well in the last 2 years, these are annualized calendar year end returns. On a 5-year ending December 25, Nifty is still done 14.9% CAGR over the last 5 years, which is not bad. Despite last 15 months in this cycle, Nifty being flattish, obviously returns got upfronted or got front loaded in the first 2 or 3 years of that cycle. Now that we're coming, so the point I'm going to make is India being a steady state 7% real growth story over the next 5 years, it's very reasonable to expect Nifty to keep compounding at 13-14% CAGR. So in the next 5-year cycle as well, starting from 1st January 26 over the next 5 years, I still think Nifty can do a somewhere around 14% CAGR. And within that 5-year, you get cycles of, outperformance or underperformance. And given the fact that we're coming out of 2 years of underperformance cycle, and more importantly, we have earnings tailwind, cyclical uplift in earnings, I think probably we are poised for a period of outperformance or trying deriving higher returns on Nifty, and which is what also one of the factors which prompted us to bring this fund at this point of time to all of you all, that we're coming out of 2 years of underperformance cycle. We can see earnings growth accelerating, and valuations are reasonable in pockets of markets and at the aggregate level as well, and which is what we want to capture through this fund. I was talking about earnings. We had very 4 years of very strong earnings growth between 21 and 24. Last year was a year of moderate earnings growth, CY25 at 4%. We think probably this year we will get to about close to double-digit earnings growth at about 9 to 10%. There could be, and that's primarily, it could have been higher, but I think there's an impact of higher commodity and oil prices, though transitory, it is impacting corporate earnings. But we certainly see line of sight in terms of getting to mid-teens kind of a growth next year, which is what India's long-term normal growth, earnings growth has been, and which is what makes us positively inclined towards equity. And as I said, we have earnings acceleration ahead of us, and we're coming out of a period of 2 years of flattish returns on the index or underperformance in Indian markets. So both of that makes markets poised for a reasonable outperformance cycle over the next 2 years, I would say, next 2 to 3 years. Having said that, I still believe on a 5-year basis, Nifty can comfortably do a 14% CAGR. India on a standalone basis also, in terms of its long-term history, valuations are pretty reasonable and probably one of the cheapest that we've seen in this cycle. In the post-COVID, in the last 6 years, probably consequence of all the factors that were discussed, probably valuations are now at one of the cheapest levels that we've seen in the last 5 years in this cycle. Nifty index at 18 times of earnings, as I said, pretty reasonable and pretty much in line with long-term averages over the last 15-20 years that Nifty has traded at. So to summarize, I think the point I wanted to highlight was Indian economy continues to remain fairly resilient. We're seeing uplift in growth, and I think growth will mean revert. Earnings growth, which has been sluggish for the last 6 quarters, is set to revive, and we should get to mid-teens kind of a growth in CY27, FY28. Markets over the last 12 months had become very narrow, where few sectors, select sectors, and within that handful or select stocks were doing well, and the dispersion had increased significantly. And that's because moderation earnings growth. But now with broad-based recovery in earnings coming back, I think market breadth will improve and become much more broad-based. And that expansion of breadth of the market is obviously positive for the overall market. And I see, and as we talk, we're already seeing signs of that playing out. As I said, valuations have become attractive and reasonable in the context of India's own valuation and attractive in context of India versus the rest of the world. And more importantly, because of India's massive underperformance in the last 18 months, India is global investors, emerging market investors are significantly underweight India, which effectively means if India starts performing well or Indian markets start doing well, then it's a matter of time before global investors start coming back to India. And I think, as I said, I see that happening probably some point of time, later part of this year or next year, certainly to be India's year where India gets its mojo back. And India becomes one of the, amongst the leading performing markets within emerging markets. Because I still believe that this whole AI unwind trend which is going on probably will only accentuate and accelerate towards the later part of this year and next year. So that which places India very favorably versus the rest of the world. And given that India's growth will accelerate on its own itself also. So with that as a summary, maybe I can now move on to friends. The idea behind this Renaissance Ascent Fund, the idea is very simple. We think over the next, we think India is in the midst of a massive, growth leap where, as you see in context, India is now $5 trillion economy or a $4 trillion economy, and we certainly see India doubling its size in terms of economy over the next 7 to 8 years. So India becoming an $8 trillion economy. Now, the idea is we try to put our head around that when we look at the next $4 trillion of output that India is going to generate, then which are the sectors which will clearly lead this and where are the opportunities to invest within those sectors, and which is what Renaissance Ascent Fund is as to how you think about the next $4 trillion of economic output over the next 7 to 8 years, which India is going to achieve, and how do you best capture that in a portfolio, which is what Renaissance Ascent Fund is focused on. From a framework perspective, all the Renaissance investment frameworks remains very similar. It's a flexi cap portfolio with a portfolio of about 30-35 stocks. As all of you all know, our bias always remains towards high growth, high quality companies. So the portfolio, the fund will invest into companies which can deliver superior growth. Having said that, quality is equally important for us, and strike a balance between in terms of valuation. We want, as investors, we are GARP, so we want to buy growth companies, but we want to buy them at reasonable valuations. And from a market cap perspective, the fund will be a classical multi-cap with exposure to all the three segments of the market, which is large cap, mid cap, small cap. With that, maybe let me move on to what are the big opportunities that we see over the next decade in India. And I'll go through each of these one by one, but you can clearly see that these are some of the mega trends that we see playing out. We need to acknowledge that world is at a point where there are significant amount of changes that are happening in the world simultaneously. I have not seen changes at such a fast pace happening in the world, anytime in the last 30, 40 years as they are happening at this point of time, and which makes investing both very interesting and exciting also on one hand, and challenging on the other hand as well, because we're seeing a confluence of factors, including technology evolution. All of us know about what's happening with AI, meaning technology is making massive leaps across some of the most critical sectors of the economy across, as I said, AI. All of us know we are in midst of now. We're in the fourth year of this whole evolution of AI. Chat GPT 1 was launched in November 22. So we are in the fourth year of, very soon we'll finish 4 years of it. And now consumers and enterprises have started embracing technology at a very accelerated pace, which creates its own sets of opportunities and challenges. We know some of the other challenges or technological shifts that are happening in the world. The two big ones which I can clearly see through is obviously within the automobile industry, which is the largest manufacturing industry in the world, is electric vehicles. And within energy, there's a huge transition happening from traditional energy sources to new energy sources across nuclear, renewable, solar, wind, hydrogen, ethanol, clean energy, and so on and so forth. So all of that is playing out. And midst of all of this, India is still in an accelerated pace of India's internet companies emerging. A lot of these, meaning there was a period between 2010 and 2020 when a lot of these startups were formed not now, but a lot of these companies have become pretty large in terms of business. And I think over the next 10 to 15 years, some of the leading companies of India will come from the internet ecosystem across e-commerce, consumer tech, fintech, medical tech, and everything else. All of us know India is the third largest startup ecosystem in the world after US and China, and I think India's startup ecosystem is really, really exciting because one, it's very competitive, so only very small percentage of companies are able to survive and scale, and then companies which reach critical mass and critical thresholds are able to accelerate their growth very significantly. Financials and healthcare are the other two big sectors which we feel really excited about because they are the core of the financials remains at the core of India's growth, and within financials also there are new business models which are emerging across capital markets, asset management, NBFCs, and so on and so forth. We'll discuss that. And healthcare, both because of domestic market and India being a low cost provider, the global exports opportunity is equally exciting. So maybe I can quickly touch upon each of these this thing, friends. Meaning this is like a AI revolution is once in a century revolution. This is like the steam engine movement for technology. There is no doubt about it. And the more, meaning now that it's been 4 years that the technology is in place, I think this technology, in terms of its impact on the world over the next 10, 20, 30 years, will be far bigger than any of the previous technology cycles and any technology evolution that all of us have seen. And as I said, which is both an opportunity and a challenge for every individual and every professional and for every business and every enterprise. Howsoever small you are, howsoever big you are in the world, the technology is the same for everyone, and it, as I said, offers both opportunity and challenges for every single human being or enterprise on the world. And given that now, as I said, we are getting into the fifth era technology, it's getting really exciting, which also means that on the brighter side, it will create opportunities to create significant amount of wealth if we can identify right business opportunities, which are on the right side of the technology curve. So while technology shifts, as I said, happens once every 15, 20 years, but this is much bigger than any of the previous ones that we have seen and experienced. The beauty is, meaning if you see some of the previous technology, smartphones took about 7 years to get to 1 billion users. AI could do it in about 2.5 years. So the pace of adoption of technology internet took 15 years or thereabouts to get to a billion users. When internet came in mid 90s, kind of. So you can imagine how fast the world has become and how fast adoption is happening, which also means changes are happening at a very rapid scale, which was what I was trying to allude to, and which also means disruption is also happening at a very rapid scale. Meaning it's expected that this whole global generative AI market will get to over $2 trillion by 2032. Now that's massive for a new technology to be able to getting to $2 trillion of size in a matter of 10 years from the launch is just incredible. We haven't seen that any point of time in the past in the world. And as I said, it's incredible in terms of what it means for all of us. In India's context, all of us know one of the big opportunity around AI is across all the three layers of AI. Obviously, India does not have our own LLMs, though there are one or two that have emerged, but they're still in the private markets. But we started scaling up our data center. Data center has been a big story globally with hyperscalers. India has started scaling up its own data center infrastructure, and that's a very significant opportunity. India's data center capacity will have a 30-40% growth over the next 5 years, and this is just the first phase of growth. I think it will be a multi-decadal opportunity. Probably can grow at 25-30% even for the next decade, kind of a thing, where our data center capacity goes from under 2 gigawatts to about closer to about 10 gigawatts by the end of this decade or early next year, and which effectively means tremendous opportunity across the whole data center ecosystem. And India still is small, but India's market share in India's global data center system will get to about data center ecosystem will get to about 4.5% by the end of this decade. Over the next 10 years, I still think India can double the market share. By 2040, I think India can get to 10% market share. India being low cost, we will attract investments from the world. And in addition to that, given India's own growing needs for data, we'll need humongous amount of data center capacities as Indian consumers and enterprises adopt AI. So AI infrastructure opportunity is very significant. Likewise is the opportunity in AI services, because eventually there'll be services which will build around these AI models, and companies which are able to deliver those services, there is a pot of gold for them. We've just tried to highlight what can be the different kind of services and how AI is either a beneficial for these services, a lot of these services. Having said that, we need to acknowledge that AI can be be a headwind also for some of the services, because AI can replace some of the services and which can deflate revenue for existing service providers. So it's a slightly complex equation where we have to look through each and every company, and companies are really every company in the AI ecosystem is looking at their business model, are having a very hard look at their business models in the last 3 years, and they're making very rapid changes to their business models to adapt to the new AI world, because some of their existing businesses or services might become obsolete 3 years, 5 years, 10 years down the line. And at the same time, there will be demand from their customers for new services, and they're rapidly building those skills, capabilities, products, people, team, knowledge, domain knowledge, and everything else. So that opens up a very significant opportunity. Probably in the next 5 years itself, this opportunity could be $200 billion. I'm understating it a bit. Infosys, if you talk to Infosys' own statement is that they see over the next 6 to 7 years, this AI opportunity will be something like 350 to $400 billion. So I think there is significant opportunity that will emerge in the AI services ecosystem. And likewise, when Indian companies will adopt AI, I'm sure we've seen early signs of it. A lot of banks, let's say, talk about financial services, a lot of banks have started adopting AI, where a lot of low-end jobs in terms of call centers or something like that are replaced by AI. That itself will become a $130 billion market in the next 5 to 7 years. So within services, there's global services, which could be about $200 billion. India's domestic AI market could be over $100 billion in terms of opportunity size across different industries, be it banks, manufacturing, technology. Every company in the world will have to adapt and implement an AI into their businesses across all different functions of business. Let's say HR can be automated with adoption of AI. Customer service can be automated in a, let's say in a markets. Training can be automated through AI, and likewise, there will be multiples and multiples and use cases, hundreds of use cases in every company, and thousands of use cases across industry, and millions of use cases across all businesses. And they will get implemented because companies will adapt all of that, and that again means a massive opportunity. It will, and obviously the end goal of that will be it will make companies more efficient and more leaner. So obviously companies will derive for the money they spend or the dollars they spend on AI, they're going to drive very strong ROIs because technology does make all of us more efficient, and it will make businesses and enterprises leaner, more efficient, improve productivity very significantly. But it also opens a very huge window of opportunity for companies who can render services around it. And we really want to be investing into some of these companies which can really do that and do that on a scale. And as I said, I feel very excited about the opportunities that lies ahead in this whole AI world. There are enough and more number of Indian companies which are playing the whole data center ecosystem. This is just a graphical example to show you all, meaning what a classical data center looks like and what can be the various kind of opportunities within this whole data center ecosystem, right from, let's say, someone providing standby power to battery systems to cooling systems to cooling towers to heating systems to managing the whole power ecosystem within how power should flow within the data center to chillers to slightly technical, but switch gears to batteries to transformers to wires and cables to managing the entire flow, airflow and water flow within the ecosystem. And there are enough and more number of companies across the entire whole value chain of data center which are there. And while some of these stocks have done well in the last year or so, but this is, mind you, this is just the beginning of India's data center story, because with adoption of AI, India's data center capacity requirements will increase exponentially. So we are in a very long growth cycle for this whole ecosystem, I believe. Likewise, uh, 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 meaning there's this one big question I thought, which arises where who makes money in the whole AI value chain. So we believe that this whole LLMs, which India currently doesn't have, which is all of us know, the two big LLMs, Anthropic and Claude, they will become commoditized. Eventually, LLMs will become commoditized, and the US LLMs are now being challenged by low-cost Chinese LLMs, and there are open source LLMs which have become available. So the moat in a LLM is not significant. It will become commoditized because even if your LLM is inferior, you can over a period of time catch up with the leader, and it just becomes commoditized. The real value creation will happen either with hardware guys, hyperscalers. Within that also, instead of owning data center, we want to invest into companies which will provide service to the data center. Because data center companies which invest in data center, again, it's going to be a real estate business partly, and it will be a low ROI business. We want to invest into high quality, high growth, high ROE businesses. So we want to invest into companies which will provide services to these data center companies. And the real value capture will happen in software and service providers, which is where we want to really focus on. So I thought I'll give you all a big picture view in terms of, given the exponential or a capex that's going to happen in the data center ecosystem, which are already happening globally and will happen in India, where does the whole value accrue from an equity point of view, or which part of the value chain will be the most value accretive from an equity shareholder point of view? So that's on AI. I think I think I did not all of us know EVs. I'm sure many of us now probably have one at our home. So India, we're just starting the EV journey. Obviously, we're significantly behind the world and significantly behind China because China now leads the world. But as you can see, we have reached some inflection point in two-wheelers where we already crossed this year, this financial year, April to July. We are now clocking 10% of two-wheeler volumes are EVs, and 10%, mind you, friends, is an inflection point. Once any industry gets to 10% adoption, thereafter it grows very fast. So we certainly think 50% of two-wheelers in India will be EV by 2030, and probably 80% will be electric by 2033, 30 to 35 or something. Next 10 years, 85% of India's two-wheeler industry will be electric. ICE will be gone. Likewise, three-wheelers, the adoption has happened very fast. Already 32% of three-wheelers in India are electric. Four-wheelers, we're still at 5%. I think it will take another 2, 3 years before we get to 10%, but after that, we'll certainly see an acceleration. And likewise, this. So the whole EV ecosystem will unlock, meaning $100 billion of incremental revenue opportunities, because the supply chain for EVs are very different. And we see significant opportunities in that whole EV ecosystem. The future of automobile is EV. Anyone, any company, any business in automobile not having an EV strategy risks its survival to the 7, 8 years from now. So, but that also means that this is a once in a century opportunity, right? The ICE engine has been around for over 100 years now. So this kind of massive shift in technology happens once in 100 years. When they happen, obviously they hurt certain companies, but they create massive opportunities, investment opportunities, and wealth creation opportunities for companies on the right side of the technology. And you cannot afford to miss it, because, as I said, this is once in a 100-year opportunity. So you have to invest into these kind of what I call once in a century technology shifts or transition that happens. And probably India is now just getting at a inflection point in that sense, what China and US and some of the other countries in the world witnessed 5 years back or 6 years back. Uh, uh, Talking about the EV ecosystem, it's across the board, be it lithium, the batteries, all of us know EVs don't have an engine. The opportunity for investing into India's battery ecosystem is very, very significant. And the demand will get to 150, 160 gigawatts by the end of this decade, and probably double over the next decade. So what I'm trying to say is, again, these investment opportunities are not for the next 5, 7 years, they are for the next 15, 20 years, and which is why we call them as mega trends. Likewise, EV chargers, all of us know that we need that for that ecosystem to be in place. Already, India has about close to 30,000 odd EV chargers, which is going to go 2.5x over the next 5 years. You can also see that incrementally every OE is launching more and more EV models. Amongst the new models launched, a significant part of new models are actually now EV models, and the share of EV models in the new launches is increasing very significantly. As you can see, and when we look at companies from their future pipeline perspective also, that is what is visible, because when you launch a model, please bear in mind the work on that model starts 2 or 3 years before its launch. It takes 2 to 3 years to bring a new model in place. So whatever model that company is launching this year, the work started 3 years back. What they launch, today they're working on models that will be launched in 2029, 30. So we have a visibility in pipelines, and clearly EV is what is going to be the driver of new cars launches, because that is where customers are moving, and that is what customers are seeking from this thing. So we see a huge opportunity in this whole EV ecosystem. I think India's internet story is now well known. We are now the second largest internet users in the world at close to $1 billion. We have 1 billion people using internet or having access to internet, and probably we have the cheapest access to internet in the world at 12 cents per GB. That's the cheapest access you can get to internet anywhere in the world. Yeah, obviously it's doing wonders and magic for businesses. India's e-commerce penetration is still very low in relation to where China is. China's aggregate e-commerce penetration is 30%. India, we are still at 12, 13%. And across categories, electronics, fashions, beauty, personal care, now and even now grocery as well, it is still pretty low as compared to what the global benchmarks are. So which effectively means, and all of us know now, the current generation is Gen Z. Gen Z is going to be the biggest spender in the next 20 years, right? Because as these Gen Zs get into working age population, incremental delta on spending will come from this generation, because from being students, they're getting into working age population, which effectively means they start spending, and they are very comfortable. They're digitally native. They're very comfortable with internet. So I think this whole internet transition or access to internet will only accelerate, which effectively means all internet and e-commerce businesses are on the right side of the curve in terms of acceleration, and are about to witness a very strong growth over the next 5 to 7 years, because customers will not go to physical stores searching for goods and services. They will search it online. They want those transactions or services to be available to them online, sitting in their office, home, car, and just be able to do it with their laptop or a phone device. That's it. So clearly, India's internet ecosystem, while we've had pretty healthy growth in the last 5 years, but I think that whole the growth curve will further accelerate from where we are, and probably we are in an extended growth period for this whole ecosystem from where we are, and we're still far behind where the world is, right? As compared to US and China, we have a lot to catch up. I'm sure all of you all know this, but there are so many of these companies across each and every part. When you talk about e-commerce and quick commerce across electronic, fashion, beauty, personal, grocery, food delivery, across travel, flight, hotels, everything else, the fintech ecosystem is evolving in terms of payments, insurance, asset management, the whole capital market ecosystem, and so on and so forth, which offers tremendous growth opportunities to be investing in all of these businesses. Financials remains at the core of our India's growth story because we are a country with, which is probably the youngest country in the world at 29 years of average age, with rising working population. All of us are going to save enormous amount of money, and there is a huge amount of business in intermediation and disintermediation of these savings. India's credit still remains pretty low as compared to the world. Despite all these years of growth, India's credit to private sector is still 50% of GDP, much lower than other countries in the world. Banking system is in a fantastic health. After 6 years or 7 years of growth that we witnessed, 6 years of cycle, the good thing is we don't see any signs of stress in the banking system. One or two banks could be stressed, but asset quality in banking is extremely pristine. And the banks are sitting in very high amount of very healthy capital adequacy levels. So they don't need capital, unlike the cycle we had in 2016 to 18. I understand that sector has underperformed in the last 12 or 18 months, but I think I'm firmly of the view that banks will deliver healthy growth and the sector will come back to flavor in stock markets. And obviously, when we talk about financials, we're just not talking about bank, but we're talking about the larger whole financial ecosystem. And on every metrics you compare India with the rest of the world, while we have made progress, but we still have a long way to go in terms of catch up with the world. And those trends are very secular in terms of where we see things will play out. So India's mutual fund AUM should double in the next 5 years from where we are at about 70 odd trillion or 75, 80 trillion to 150 trillion. Uh, uh, Household allocation of equities, despite whatever growth we've seen, is still under 6% compared to US, which is 22%. Penetration of broking accounts is just about 5% of the population, and everything else that you look around. So I think there's huge, tremendous growth opportunities across everything. Still, financial services is accessible to a small cohort of the target users. So we still have a very long way to go. As you can see, India has about 50 million active investors into stock markets or into mutual funds, whereas we have 500 million UPI users, and there are 660 million Aadhaar card or PAN card holders. So as you all can see, we have still a very long way to go in terms of persevering and driving penetration within financial services. World is in midst of energy super cycle because of two primary reasons. One, in the last decade between 2010 and 2020, globally the world did not invest into energy, new energy capacities. So as a result, all the spare capacity in the world got absorbed. And this whole AI-driven data centers, which are extremely power guzzling, have created a new impetus or new demand for power. And energy is one such thing where you cannot create capacity overnight. It takes 3 years, 5 years, 7 years to bring new capacity on stream. So I think this whole energy super cycle is going to sustain for a period of time. And as I said, and while there is such a strong growth in energy demand, the whole ecosystem is going through a transition because the world is transitioning from traditional fuel sources of coal and thermal plants to new fuel sources to meet its demand, which is essentially while the traditional thermal still remains, but in terms of nuclear, solar, hydrogen, wind, hydropower, and biofuels. And I think this trend is going to persist or at least for the next 5-7 years in terms of the super cycle of growth. And even after that, when it settles, it will settle at a normal, which will be much higher than the current demand levels, which effectively means there's tremendous opportunity for companies within the whole ecosystem. So obviously, nuclear is going to be the next frontier driver for India over the next 10 years. Government of India has already passed a bill or legislation for building nuclear power plants in India. All of us know India's apart from solar and renewable, all those opportunities exist, and they've been around for a while. In the last 5, 7 years, we've had companies in capital markets around that. But I think nuclear is going to be the new one because we've still not started with our nuclear power. India gets just about 2% of its energy from nuclear sources compared to other countries in the world. As you can see, US gets about 20% and France gets 70% of its. This thing the government has a target to get to 100 gigawatts of nuclear capacity over the next 20 years, and which effectively means an investment of $200 billion over the next 20 years. So these are really, really very large numbers over a very long period of time. The capacity addition on renewables across solar and wind has been very strong, and that continues. But I think nuclear becomes the incremental delta. And apart from that, which so far it's just been standalone solar plant, the big change, the next delta will be battery energy storage systems, because you cannot run standalone solar plants because there are issues with transmission. All of us know solar plants generate power for 6 to 8 hours a day during sunlight. That power has to be stored and used through the day. So you need energy ecosystem, battery energy to store that power. And that investment in India has not happened. It's just starting. So the next two big drivers in the whole energy ecosystem, apart from the continuing growth from renewable energy, is going to be battery energy storage system and nuclear power. And I think, again, there are massive opportunities in the whole ecosystem. Healthcare, India is the healthcare capital of the world. Estimates suggest, meaning, and as a country, we are significantly underinvested in the healthcare ecosystem. We need to make affordable healthcare accessible to, probably each and every Indian, which means massive investments in the whole ecosystem. So the healthcare industry probably will double over the next 5 years from about $7 billion on the organized side to $15 billion, and still will have a very, very long way to go. And obviously, a significant part of these investments is made by private sector because governments being constrained for resources. So healthcare or hospital ecosystem will go through a significant growth curve, already witnessing it, but I think that's an opportunity for the next 15, 20 years. And likewise, India's pharma industry is poised for very strong growth. Now, Government of India estimates that India's pharma industry, both domestic and exports taken together, should double over the next 5 to 6 years, from $60 billion to 120, $130 billion. Within that, exports itself from where they are at $30 billion should double over the next 5 years and still keep growing for a long period of time. And within that, there are opportunities across the whole ecosystem, right from biosimilars to, Indian companies are getting into innovation and APIs and all of that. All of us know that India is the least cost producer of generic medicines in the world. No other country can compete with India. So that's a very strategic competitive advantage India has. And India is solving a lot of problems for the world by producing medicines very cheaply. And we're seeing a strong evolution of India's CDMO space because developing drugs, doing research is much cheaper in India because lower manpower cost, lower infrastructure cost in India versus the rest of the world. So again, once again, tremendous opportunity in the whole ecosystem in healthcare over the next 5 years and the next 20 years as well. With that, I think I've covered all of this. So maybe I can quickly give and I think I'm already 40 minutes into this thing. I can quickly give a brief snapshot. Maybe Shalini, I can hand it over to you to carry through the brief snapshot of the fund, and then probably I can we can take questions as people have.
Sure, Pankaj. Thanks for that. So thanks everybody for this opportunity to present this new strategy to you. We've structured this as a close-ended Cat 3 AIF. This allows us an opportunity to call for funds in a staggered manner. While we have been engaging with a lot of you, I think one of the requirements really coming through was that investors, in light of the volatility that we are seeing, would be keen to perhaps invest in a staggered manner. The market, of course, is giving multiple opportunities to deploy capital at exciting levels. Accordingly, we've structured this as a 5-year fund. While it's close-ended, there's no real hard lockup, which means that clients can exit at the exit load if they wish. So we have 3 years of exit load. 25% into 4 installments is what we have in mind in terms of tranches. The first one, of course, would be applicable at the time of the initial investment. We have, of course, both digital and physical onboarding. I think teams from various locations, as you know, we're in the top 7 cities in India. Our teams would be in touch with you. So physical forms, of course, are very much available. Digital is a pretty easy way to go. So we would urge all of you to explore that path. And then subsequently, we would call for the remaining 25% tranches at, the discretion of the fund manager, expected to be somewhere between 8 to 12 months for the complete drawdown. So that's largely how, we are structuring this. There are various share classes typical for all Cat 3 AIFs, depending on the ticket size. We have both a fixed as well as a hybrid option where there is a, profit share component. So fairly standard in line with, market practice and our other ongoing AIFs as well. I think what we're hearing from everyone is that this opportunity is quite compelling because after 2 years of, I think, no returns, clearly investors are looking for very compelling themes, which will make them, look again actively at Indian markets. Many of clients we talk to are underallocated versus their investment policy, and I think 2 years of, low returns and equity has possibly made them a little tired. At least, that's what we see when we talk to many of our investors. But clearly, as we've been presenting these ideas and these mega trends, so to speak, clearly these are, very high growth opportunities in the market, and logically, stock markets reward high growth companies. So that's, really what we're looking at from a, marketing perspective as well. We of course have a deck which we'll share with you, and one pagers and all of that. So please do reach out to us centrally, our customer care or your relationship managers from Renaissance, and we'll be happy to take it from there. I'm seeing one or two questions in the chat box. So Pankaj, maybe I'll just read them out. Madan had a query regarding valuations. So his question is, valuations from an entry point perspective are stretched across most of these sectors. So how do you see this from a deployment perspective?
Good question. So, Madan, I think what we need to do is we need to distinguish when it comes to high valuations between sustainable growth and cyclical growth. So obviously, as I said, the idea is to one, identify opportunities where we think the growth curve is much longer than just being 2, 3 years, being 5, 10 years, and probably longer. And within that, identify companies which can do a great execution. And within that, obviously, then valuation does come into consideration in terms of stock picking. We want to make sure that we're buying companies at a fair price or reasonable price. Optically, in some of these companies, valuation might look rich on a PE basis, but given the long growth curve, it might not be. Markets are this pricing mechanism where they tend to price out growth over a longer period of time, kind of a thing. So in some cases, optically, the valuation might look rich, but still these companies can continue to, deliver very healthy returns. So we are very mindful of that. Point number one, we want to make sure that at stock selection level, we're buying companies at a fair or reasonable valuation or where we have comfort. And secondly, which is also why we have these drawdown options where we're saying that, in case of an external event, and I'm saying this because last 12 months have been extremely challenging from a, volatility and geopolitical event perspective, where one, there's been a lot of global events and uncertainty around tariffs, and then India's punitive tariffs, and then this whole Iran thing and all of that. And we've had our own share of, events kind of thing in India as well. So, which is where, given that we're taking a slightly more longer term view, we're saying that investors probably can take that route where they can invest in money in, 4 call options that we have of 25 to 4 kind of a thing. So we can just stagger it over a period of, about 9 months or so, thereabout. So kind of, so combination of these two should, one, the staggering of investment should help us even out volatility from a year one perspective. And from a medium-term perspective, if our companies execute well, we are very mindful of making sure that we're buying company at reasonable valuation. Obviously, that makes our job slightly more tougher in terms of being able to identify those companies. But given the the kind of opportunities that are out there, I'm reasonably confident that, and we can obviously, as you know, we have a list of potential investee companies in terms of which we've already shortlisted and identified. So obviously we can see those ideas, or we can find those ideas where we would have comfort to be able to invest in these companies at current prices or around current prices, and see healthy returns over the next 2 to 5 years. So those kind of things are really visible to us.
Okay, got it. Thank you so much, Pankaj. Just to clarify, when you say healthy returns, are you referring to ROE or ROE? Or both?
So, ROE, ROE.
ROE. Okay.
So
Also, to add on, we would be having two NAVs for purchase per month, and redemption would be once a month. So I think one of the other reasons that fund managers, really find it easier to manage an AIF structure versus, say, a PMS is that in a pooled vehicle, every 15 days, there is a fresh influx of funds as well. Various new investors keep coming in at different points of time. So both in terms of new ideas, averaging out, finding opportunities at different points of time. AIF structurally being a fund and a pooled vehicle, we get this opportunity to keep buying at different levels. So that both in our existing ongoing AIFs as well as a close-ended structure, that benefit is always there. Our next question, Pankaj, is from Avinash. He says, what is the average ROE, PAT, and EPS growth for the large, mid, and small cap indices? Is there any growth projection in large cap companies as PAT growth in recent months shows unfavorable numbers?
Yeah, so I think you're asking for the index, right? In terms of the large cap index, mid and small cap index, is what I understand your question is. If you look at the Nifty index, the Nifty ROEs are around 14% or thereabouts, so which is still not bad. Yes, Nifty PAT growth has taken has been impacted. But I think there also, I think we will have a cyclical uplift. And I still believe that Nifty companies can do a 14-15% kind of a earnings CAGR on a consistent basis over a period of time. Last 18 months has been challenging, but we also have to see that 18 months in the context of the fact that prior to that, for 3 years, companies had a very strong earnings growth, and the economy did hit air pocket in terms of whatever happened with sluggishness in demand, rising commodity prices, tariff-driven uncertainty, and all of that. So I still think that the large cap companies can still do a 14-15% earnings growth, and Nifty has a pretty healthy ROE at about 14%, pretty decent if you compare it with the regional benchmarks or global benchmarks as well. Obviously, the earnings growth CAGR for mid and small cap is much higher. The mid cap is higher than large cap, and small cap is even higher than mid caps. Mid cap next year probably is expected to do earnings growth of about 20% plus, and small caps are more like 25-27%. But and ROEs are also pretty healthy in mid and small caps at about 17-18%, in case of mid and small cap, if that is your question. But also in terms of valuation, they are more expensive than large caps as well. So, while Nifty is trading at about 18 times 1 year forward earnings, the mid cap index is trading at about 22-23 times, and the small cap index is trading at 27 times. So a lot of these, all I'm trying to say is one has to be more stock specific and selective, because in a lot of cases, this growth is priced in as well. So, and also what I'm trying to say is, now from here on, there'll be because mid cap and small cap, all of us know, has done very well in the last 18-24 months. I must concede that it has surprised me also. Because if 18 months back someone asked me, if someone told me that mid and small cap would have done so well, I would have not thought so. Given the uncertainty and macro concerns that were around, I would have not been so positive. So I'm surprised by that. And having said that, my view is that we have to look at slightly more. It's not about now mid and small cap as a tailwind, because within sectors also we're seeing companies doing well and companies not doing well. So it's all about your ability to, and I find, while I find a lot of opportunities, I find equal number of stocks which are mispriced. All I'm saying is it's a classical bottom-up stock picking market, and which is fantastic. Because that is where you can really bring your skill to the play in terms of picking the right companies with durable business models, thinking through how the risk to the business, how business can deliver growth over the next 3 to 5 years, and find companies where either growth is what I'm saying. What should I say? For probably market is not fully priced in the growth potential of the company, or underpricing the growth potential of the company over the next 3 to 5 years, just because the company is not done well in the last 2 or 3 years or 1 year or so. Market at times could be mispricing mispriced growth opportunities in good quality companies, I would say, and I find quite a few of them in that pocket as well. So I think, and why at this point of time is I must concede that one of my bigger concerns over the last 12 or 18 months has been about India's macros. India's macros were really vulnerable, right? Currency 10% adjustment in a year, 10-year bond yield going from 6.2% to 6.9%, oil at $90, $100, and so on and so forth. All of these things did really concern me or kept me concerned over the last 12, 18 months. But now that macro concerns are receding, the world looks to be a stable place, kind of a thing. And this whole AI trade, where India is a reverse AI thing, or is reversing, where flows were just relentlessly going into few countries and within those countries into few pockets and few stocks. All of that is started receding and reversing, kind of a thing. So I think all of this gives a good backdrop to create a classical multi-cap fund with allocations across all the three segments of the markets. And I think the real alpha returns or alpha will be created in bottom-up stock picking. So, opportunities are there because the economy is in a economy aggregate basis is 7% growth. Within that, there is a very big skew. There are companies which are growing at much higher rate, and there are companies which are not doing well. So it's all about your ability to position your portfolio in right sectors and within that right companies, right set of companies, and which is where we identified these themes where we think these are decadal growth opportunity. And within that, then how do you invest into, high quality companies within that whole ecosystem is what our endeavor would be. So slightly long-winded answer, but since you asked this, I thought I'll give you a holistic perspective on that.
Pankaj, we have an extension to this question. Do you have any specific allocation between large, mid, and small as a minimum or maximum for this new fund? Are there
No,
any fixed buckets you have in mind?
the threshold we have is that we want to have, because large caps provide some degree of stability as well. So we want to have at least 35% of fund in large cap, not lower than that. So at this point of time, our thought process is probably going to create a classical multi-cap fund with about 35 to 40% allocation in each of the three buckets. So let's say, 35% in each of the three buckets of large cap, mid cap, small cap, and then give or take 5%, depending on where we find the opportunities.
Thanks, Pankaj. Nilesh has a question. Your overall take on the Q1 numbers, which are already announced, any positive or negative surprises sector-wise, any broad sense?
I think so first of all, the one big takeaway from Q1 number is demand momentum, underlying demand in the economy is resilient. Because everyone went into Q1 numbers hoping that numbers will be very bad. Because the whole Q1 was completely washed out because of $100 oil prices, shipping lines, dislocation on shipping lines, supply chains being impacted, raw material prices gone up very sharply, and all of that. And in fact, we had sensed this in April, May as well, itself, when we were talking to companies, when all of this the first leg of Iran war was going on, when we were talking to the companies. The feedback we were getting from all the companies was that the demand is very strong, and which is why companies were saying that we are not taking price hikes, we are not passing on higher raw material prices to customers because we don't want to negatively impact the demand. And they believe that this oil price eventually will settle down, will come back once this war settles down. So they believe that this price increase is transitory, and which is where they're willing to absorb that for a period of time and not impact customers, and which is what exactly has seen. If you see demand numbers across, meaning growth numbers across, automobile growth has been very strong, and so many other pockets of consumption where we're seeing after a very long time, meaning what is this company, Burger King, some very extraordinary, meaning the highest growth number in the last 12 years in the last quarter. So meaning I'm sure they've not thrown those burgers in the dustbin. Someone has eaten all of those burgers, kind of a thing. So there are pockets of economy where we are seeing very strong growth trends. So one big takeaway is that I'm drawing is, and mind you, this is happening still in the midst of an environment where it's a year where we will have a monsoon deficit. It's El Nino year. But again, I don't see that as a significant negative impact, because our conversation with a lot of companies and a lot of people in the ecosystem is that rural India has changed significantly. Today, meaning most of the families or a significant part of the families in rural India, which depend on livelihood on their farm, they've diversified their income stream. So what used to happen 20 years back, that farm income was the only source of livelihood. Now they have two or three sources of their livelihood. Farm is one of them. It does impact, it will impact their, in some cases, their income levels, but it will not push them into distress because they have they've diversified over the last 20 years, having gone through multiple cycles and all of that. So the point I'm going to say is this demand is holding up and is doing pretty well despite some of these headwinds, which effectively gives me a reasonable, meaning hope that as we get into festival season this year, probably we should look for very healthy demand trends. Now that the macro headwinds are behind us, as I said, I'm still in the camp. I don't see rate hikes in this financial year because all of this inflation is cost push inflation, supply driven inflation, supply chain driven inflation, which there's no point in killing demand to deal with that inflation. You just need to allow time for supply chain to settle down, for commodity price to find their new normal. And then if you find there's a durable inflation, only then the central bank should be raising rates. So I think the central bank or RBI will be mindful of that, and they would wait for things to settle down and see what the durable inflation is, which is why I think that we'll have to revisit next year, probably sometime in March, April. By that time, probably things will be in a better shape and all of that. So I think the one big takeaway that I was trying to say from this results is the underlying demand momentum is very strong. We've seen very strong results across automobiles, especially, and some of the consumer companies have also surprised. And capital goods, the numbers have been equally strong. So, meaning, as I said, what we are seeing is it's a K-shaped economy. There are pockets of economy which is doing well. For example, the entire service economy is doing pretty well. Hotels, airlines, and all of that. The airlines got impacted because of crude prices, but otherwise demand has been strong. And there are pockets around, industrial capex, which is doing well. There are pockets around consumption, which is showing revival. There are select banks and financial companies across NBFCs, they're doing well. So, and obviously there are pockets which have not done so well. So one will have to be slightly more nuanced in terms of this. It's not a top-down thing. You take a top-down view when the whole economy is firing, every engine in the economy is firing. But I must concede that's not the case. But I think there's enough and more once you identify these trends to be playing on that trend. I'm just saying we're just starting a semiconductor ecosystem cycle, right? The first semiconductor plant will start manufacturing where we first have the first Indian chip manufacturer will be sometime in 2030. Now there's a huge investment that's happening in the whole semiconductor ecosystem, and that throws up new set of opportunities, completely new set of opportunities which were not there in India, kind of thing. So a lot of these kind of things are happening, which create a lot of new opportunities, is what I'm seeing. And as I said, the first quarter numbers does give confidence that probably second half onwards we'll see even better earnings growth, and the demand momentum should sustain unless
Pankaj,
something unless President Trump or something does something more, meaning that's anyone's call, meaning if you get something a bigger economic shock than Iran war and oil prices, then all bets off. I'm just saying.
Pankaj, one last question, I think, in the interest of time. It's kind of an extension of this. Which sectors currently offer the best margin of safety?
See, classical Warren Buffett margin of safety is not there in India in most of the sectors. In some of the sectors where it is there, one would not want to invest into those because those are value and deep value sectors, and they can remain value for a long period of time. Having said that, India is a growth market. There is reasonable, you can buy a company at reasonable valuations. And that opportunity is there, I think, there. And more so, I see those opportunities in some of these new emerging sectors, as I said, across nuclear power, we see opportunities, let's say, in the EV ecosystem, while some of the stocks are expensive. But I'm just saying, for example, we already own in our portfolio, an existing portfolio company called Warauck Engineering. Now, they had their results last evening. Today, the stock was up 12%. But I still think that at 22 times 1 year forward earnings, they are part of the whole EV ecosystem. They've had a fantastic first quarter because in the first quarter, EV two-wheeler volumes across Bajaj, Ather, TVS are up by 50% plus, and the outlook is even stronger because the demand for EV two-wheelers is really, really accelerating. So I'm just saying that given that, and they're riding on tailwind of all of these companies, so the demand outlook for growth outlook is very strong. So now this is a completely new market, EV market, which they were seeding for the last 3, 4 years. They've certainly hit an inflection point because consumer adoption, because of higher oil prices in EV has suddenly increased since March. Where today there is a, I don't know if some of you have checked it, but you can go out and check it. On most of the EV models, there is a wait list across all the major players, anywhere between 5, 6 days to even going to 3 weeks. Because companies are short of components, supply chains, and all of that. Because the demand is caught up so quickly that companies are really struggling to keep up with this space. So all I'm trying to say is that there are these pockets of opportunities, and where you can find companies which are still reasonably priced, and there are many of them in that context. And this is what we really want to go out in this fund, take a 5-year view on those companies. And as I said, we are very cash flow focused. We want to invest in companies which will generate cash flows, which are reasonably priced. We don't like investing into companies which have a lot of leverage on the balance sheet. So these are companies with very moderate leverage on the balance sheet or no leverage, going to generate cash flows, and the business will become multi-time bigger. In terms of the size and scale of the business over the next 5, 7 years. So I think a lot of EV-driven, let's say, auto INCs, which are focused on EVs, will become multi-time bigger in the next 5, 7 years. Because for all the investments they've made in the last 5, 7 years, now they're getting to a stage where they're starting reaping the benefits of those kind of investments.
Pankaj, we'd like to end this session with an interesting question, which I think is on all our minds. Pankaj, can you hear us?
Yeah, I can.
So the last question, as always, is the one that's on everyone's mind. Where do you see the Nifty 50 target by the end of this year?
End of this year. Let me start with a simpler thing. I think my personal view, Nifty will double in 5 years. Okay, first. So the longer the time horizon, the easier is the this thing. Point number one. Point number two, I think what I was trying to allude to in that discussion was, I think some point out in the next 2 years, next 18 to 24 months, India will get a one big year in terms of equity returns where India will outperform the world significantly. India is underperformed. I think the worst of underperformance is behind us, and India will give a massive year of outperformance versus the rest of the world. Because I think all the stars, everything that led to India's underperformance has now reversed kind of a thing, and those headwinds have become into tailwinds. So I see that happening in the next 12 years. To my mind, CY27 is that year where India will outperform the world. End of this year, the way I see things playing out, I think we are in for a new high on the Nifty. That is my meaning. This thing that will make a new high. This time around, I am very hopeful that this time around we will not have a false breakout. We will make a decisive new high. When we take out that whatever that number is, 27,000 or something, I think 26, 27,000 that we made on the Nifty. This time we'll take it out decisively, is what I believe, around 27,000. So
Thanks, Pankaj. So looks like there's much to look forward to in the year ahead. So with that, I'll call an end to the session, I think, in the interest of time. Thank you all so much for being with us and being part of, the start of a new initiative. It's always an exciting time when an AMC launches a new fund. So we appreciate your time this evening. We look forward to meeting you all, engaging far more closely in the weeks ahead. And thank you, Pankaj, and very warm thanks to each and every person on this call. Have a very good evening, and we hope to see you very soon. Bye.